Hey everyone, it's Iggy from the Investing Iguana, and today, let's walk through Singapore's October 2025 dividend calendar together. Real talk on what's actually worth your money and what's a bit of a trap. If you're like most investors here, you might get that little thrill seeing a juicy dividend yield in October. But here's the truth, some of the high flyers aren't the golden eggs they seem. So you might be wondering, which payouts are truly worth your cash this month and which ones are just hype? That's what we'll crack open together. Stick with me and we'll go section by section through October's landscape, dig through the sector mix, spotlight the three standout stocks, flag the riskier watch list plays, and clearly lay out which to steer around. Along the way, I'll share exactly how I'd approach my own portfolio for dividend safety and share tips you won't see in any generic investing vlog. And if you're new around here, I've spent years breaking down the quirks of investing in Singapore so you don't have to drown in jargon or guesswork. All right, first up, October's ex-dividend calendar features 16 different Singapore stocks. Yields range from around 0.6% up to above 3%. But here's what should grab your attention. The average yield clocks in at just 1.57%, lower than what most income chasers aim for. Already, that tells us there are more duds than gems on this list, and many of these payouts just aren't built to last. Let's break down how these stocks spread out. Picture a pie chart. Over half of the dividends this month come from the materials, industrial, and financial sectors. That's pretty telling. It means, yes, Singapore's economic strengths are in those areas, but it also exposes you to the kind of boom and bust swings these industries are known for. If you're only looking at the yield column and missing the sector story, well, that's where the trap door is. Now, here's where things get interesting. After wading through the numbers, only 3 names truly earn a spot on my buy list. Let's take them one by one. First up, SGX. At first glance, a 0.63% yield doesn't feel thrilling. But hear me out. SGX's total dividend for 2025 comes in at $0.375 per share, showing 9% growth from last year. It's not just a number, it's about SGX's consistency. They've got a monopoly as Singapore's only stock exchange, so their revenue streams aren't going anywhere. Plus, their 63% payout ratio means there's cushion for more growth down the road. Imagine a steady staircase, dividends heading upward, no big dips. If you want stability in a storm, SGX is it. But why should you, and honestly, why do I, focus so much on this one? Because as Singapore cements itself as a financial hub, SGX is the best way to own that long-term trend. You're not chasing flash, you're buying sleep well at night money. Next, UMS Holdings. Yields at 0.72%. Again, not massive, but don't stop there. UMS is a way to tap into the tech and chip boom without betting on the overseas giants. They're in the semiconductor equipment game, and their customer base is nicely spread, so one bad tech cycle won't knock them over. What I really like? UMS keeps their payout ratio at a sustainable 57%. In English, that means they don't stretch themselves thin to pay investors. There's room to grow. Dividends come 3 times a year, and their balance sheet is rock solid. I know sometimes industrial names sound boring, but UMS is a slow and steady wins the race play, riding the world's hunger for chips without the crazy risk. Third, BRC Asia. Dividend yields 1.43%, the best of the buy bunch. These guys are all about steel reinforcement, so if Singapore keeps building and our government rarely stops, BRC profits. Their payout ratio is conservative, 32.5%. Dividends have grown 5 years straight, and with regional operations, they're not just betting on one country. Imagine a construction crane lifting year by year. That's their dividend trend. Halfway through, now here's your natural don't miss out plug. If you want the full review tables, checklists, and all the nitty-gritty numbers, I put everything on Substack. The link's right below for you. Back to the list. Let's look at some yellow light stocks. GKE Corporation shows the highest yield at 3.43%. Sounds tempting, right? But their dividend amount is tiny. And as an industrial play, their profits can swing wildly. High yield, high risk. So make sure you're watching their earnings if you step in. HC Surgical Specialist dishes out 3.23%, and it's in healthcare, which tends to be more stable. But don't get lulled. Small cap, uncertain business swings. Civmec trades in Australia, pays in AUD, and offers a 2.69% yield. If you're not hedging your currency risk, Part of your payout could get wiped out just on the exchange rate. Are these set it and forget it buys? Not at all. You'll want to keep one eye on earnings and one eye on cash flows. These are fine to watch, but risky to anchor your income plan on. Here's where I come down firm. 10 of October's stocks shout avoid. Prime US REIT and AMOVA STC AR REIT. Weak yields, currencies that aren't SGD, spotty histories. New Toyo. Sure, 2.08% isn't bad until you see that they pay out more than 90% of their earnings in dividends. There's just nothing left in the tank for bad years or future growth. Some others, Alliance HC, Reclaims Global, Union Gas, they're paying dividends so small that transaction fees could eat up your whole income. That's not income, that's loose change. If you love checklists, just know, high payout ratios, weak earnings coverage, and absurdly tiny dividends are bright red flags you'll want to sidestep. So where should your money go this month? Let's build a model portfolio. Core holdings, at least 60% to 70%, should be split between SGX, UMS, and BRC Asia. For stability, growth exposure, and a toe in infrastructure. Around 10%, 15% goes to GKE if you want a shot at higher yield, but eyes wide open on risk. Maybe 5%, 10% in HC Surgical for a bit of healthcare resilience if you're comfortable with the size. Avoid the rest. The REITs, stretched-thin materials firms, and minimal dividend payers are just not worth the stress or the transaction cost. Allocate your portfolio like a chef making a balanced meal. Plenty of nutrition, a little spice, but nothing burnt. There are traps that can snare even the most seasoned income investors. Companies with high payout ratios, above 80%, are at real risk of slashing dividends if profits slip. Heavy exposure to materials or industrials? This makes you vulnerable if there's a sudden slowdown. Foreign currency pairs, like those dishing AUD or USD, require hedging. Otherwise, you get double hit by bad earnings and forex swings. It's not about avoiding all risk. It's about building in buffers so one blow doesn't flatten your whole plan. A quick sidebar before we wrap up. One trend catching my eye. More Singapore companies are favoring buybacks over dividends. You might see fewer and smaller payouts as firms choose flexibility over recurring commitments. And ESG matters too. Some firms are plowing profits into green upgrades instead of distributions. Add to that, interest rates rising, and the math for dividend stocks versus bonds starts shifting again. Let me leave you with a simple plan. Top up SGX before October 16th. Hard to beat for calm consistency. Consider UMS by October 9th, catches the chip recovery wave. Evaluate BRC Asia before October 22nd if you want an infrastructure kicker. GKE and HC Surgical, watch them like a hawk. Only step in if you can monitor their financials. Avoid REITs, payout stretched materials firms, and barely their income names. Your future self will thank you. Here's my honest take. As someone who lives, breathes, and sometimes obsesses over local income stocks, don't chase big yields for bragging rights. Anyone can buy the riskiest dividend, but it takes discipline to build a portfolio that lasts through thick and thin. What matters most? Business quality, payout discipline, and being willing to say no to what doesn't earn your trust. In my own picks this month, I'm overweighting those steady compounders, and honestly, sleeping a lot better for it. If there's one thing to remember, it's this. The best dividend portfolios in Singapore aren't built in a month. They're crafted pick by pick with your eye on both the headline numbers and the story under the hood. So, if you're planning your next move, keep these criteria in mind, and don't let headline yields cloud your judgment. What are you looking at this month? Drop your picks in the comments. I love seeing what strategies the community's taking. And hey, if you want my full tables, reference checklists, and all the premium breakdowns before anyone else, consider joining as a paid member on Substack. You'll help keep the community sharp and get early access to all my deep dives. If you found this walkthrough helpful, you'll love my video on beating the big index, next level portfolio tips for 2025. Just click through and I'll see you there.